Hello. I'm going to break down the Cheno Down Payment Assistance Program for you today. I'm going to compare and contrast it to a regular FHA loan and an FHA loan where we give a closing cost credit. And then we're going to look at the pros and cons of the Cheno program. There's a couple of different ones that I'm going to be sharing with you. And we're going to talk about all the opportunities for you to become a homeowner this year. Are you ready to get started? Okay, this mini, I'm gonna have to put her off of the desk right now.
And this is just a gratuitous Minnie Lou shot. Say hi, Minnie. Say hi. Oh, she's so cute.
Here we are with a little cheat sheet that I made. This came about from a client that he just didn't fit the traditional mold for a buyer program. So we had to seek out the exact right product for him. And being a loan broker, we're able to do that. We're fully equipped to shop for you. You come to us, tell us what you would like to do, and once we get all of your documents and figure out what your income is and make sure that's all solid, we go shopping for you. One loan application, one credit pull, and then you leave it up to us to find the exact right match. Now, this particular client, his exact match was the Cheno program because it offers FHA Spot Approval. So I hope I remember to tell you about that later because it's really important. $549 sales price, 3.5% down. Let's look at the regular FHA, 4.625 rate, 38.51, 31,000 cash needed to close. That's your down payment and your closing cost. Of that, 12,000 and some change can be paid by the seller, and you just come in with $19,000. I like this product very, very much because it yields the lowest payment. When you look at this product in comparison with the Cheno program, Forgivable Second, it's a full $700 a month cheaper. That's over $8,000 per year savings. So it is a superior product if you can figure out a way to pull it off. And my thing about all of that is that, you know what? This program, it's more expensive, but if it gets you in the house and you have been wanting to own a house but just couldn't save $20,000, then this is the program for you. So let's go into the FHA with lender paid closing costs. So in this regular FHA, let's say the seller is not going to pay for you, but you still want to do regular FHA, you can. What happens is we raise the interest rate to 5.8 from 4.625. Usually, I don't see this big of a spread. Usually in pricing has been so volatile the last few months, and especially the last few weeks. Like, you know, we could look at it 2 days from now, and this closing cost credit, you know, might only price out at like 5.2. And we had the last couple of weeks priced it out. It was like 5%. Paying this $11,000. So these rates, this is not an offer to lend. This is for informational purposes only. I want to share with you and show you what you can do, what opportunities are out there. FHA lender closing costs, 5.8, 42.68. You need $20,000 cash to close because the lender is giving you a credit. And the way we do that, there's money in the rate. So we raise the rate and we give that $11,000. Then you need to come in with your $19,000. So this program, in comparison with regular FHA, is only $19,000. Now let's take a look at this Cheno program, right? The Cheno Forgivable Second. It is forgivable after 36 months. That's 3 years, which is pretty cool that they forgive it. You know, in the Cal HFA programs, you get a second and a third, and they do not forgive those. So I feel like it's very cool that they're able to do that. But let me show you why. Let me show you why. It's not them being nice. Basically, what they're doing is they're collecting an extra $700 a month from you, which is $86.88 per year. So after 3 years, what is that, like $24,000? So you're repaying them basically through that higher payment. when we look at the funds needed to close in this program is $31,000. So obviously, if you had $31,000, you'd be doing the regular FHA, right? But the caveat is that in this forgivable second, the seller can pay all of this $31,000. In the regular FHA, you have to come in with your down payment money. In this program, the seller can pay this $31,000. That's largely so the $20,000 that you're going to get from the buyer program, here it is, $19,000 that you're going to get from the buyer program, that's going to pay for your down payment. The seller can pay all the rest of the cost, which are $31,000, right? It's a much more expensive loan than the regular FHA or the FHA with closing cost option. The con is you get into the home. One of the reasons why this program was not more prevalent in the last 2.5 years, I have barely done any buyer programs the last 2.5 years. And the reason is in Southern California, the market has been so incredibly hot. There's no way you could write an offer and get your offer accepted. You know why? Because they were taking the people that are putting 20, 30, 40% down. They were taking the people that could have loan approval in 5 days, or actually offers where there was no loan contingency, no appraisal contingency, and you're paying $50,000 over the asking price to win the offer. So a person that needs a down payment program and needs closing cost money, they were not getting their offer accepted. But a really cool thing is happening right now that we're starting to see is that prices are starting to cool down in many markets and plateau. We're coming to this like normal area. Sellers that had once dictated what the sales price was going to be and didn't listen to their agent, those sellers are not able to do that anymore. And in all fairness, if an agent went out to a property and this property were, the comping at $650 and you're signing the listing agreement and we're clipping at 3 to 5% increase, per month or so. Well, the listing agent could list on the high side, even a little bit higher, and go with what, at a $650. If the seller thought their house was worth $700, maybe they could settle on a $690 price. And guess what? It would sell, right? It would sell. Well, now with the higher rates, we've had some pullback. It's not as affordable. And then people are a little weary of what's happening, right? So when people get scared or get fearful or think that they need to wait, then inventory starts to increase. And we've had a lot of inventory increase times 3 in the last few months. So we still need more inventory. We're back to 2020 levels, but that's what's going on. So home buyers, first-time home buyers, buyers that need down payment assistance, it's your lucky day because you get to play real estate now. All right, so this forgivable after 36 months. We talked about it being $700 a month more, but this is the cool part about the forgivable one. So after 36 months, you can streamline, because what happens is that second falls off. And now you're left with just a first mortgage. And in first mortgages, why I really like the FHA loan is that you can do something called a streamline. A streamline loan is just way less documents. And you know how like when you first bought your house, there's like this much documents to do? Well, streamline is like this much document. So it's not that much documents and there's no appraisal. Everybody pitches in and reduces their fees to really make it a rate reduction in place. So you're not adding like $10,000 or $20,000 to your principal balance. Maybe you're only adding $1,000 or $3,000. I mean, it's very, very minimal. And then you get to save money. And what we're going into is a recession. In recessionary times, the government says, hey, we need to do something. We're in a recession and let's lower the interest rates to stimulate the economy through housing. So it's not a question of if, it's when. I don't know if it's 9 months, 12 months, 18 months. But when we're in the middle of a recession and the Fed decides to aid in recovery by lowering the rates, I don't know if they're gonna lower the rates. If the rates go up a couple more times this year and we're in the 8s and 9s, are they gonna lower the rates back to the 6s? Or are they going to lower them back to the 3s? I think that's the biggest question. But whatever you do, we need to make sure that you're doing it. Hold on. We need to make sure that you're doing it to maximize your benefit. That's what we want to do, maximize your benefit. And if owning a home, the only way you can do it is through a down payment assistance program, then that's how you're going to do it. That's how you're going to create wealth, security, and leverage against rent increases. Because what is going on with rents, right? Rents do not go down. They do not. No landlord ever said, oh gosh, I'm going to lower the rents this year. They don't say that. What they do is they keep going up, and they went up 20 to 35% last year. That's huge. They're anticipated to go up 20 to 25% this year. And when you get into a place, they're allowed in California, they're allowed to increase rents by 10% every year. And I know every corporate landlord is doing that. So owning a home is going to assist you in leveraging against rent and build your wealth. There's a repayable second where you make payments on it. And that's why this repayable one right here is so much higher. And just yesterday, I am not even kidding you, just yesterday, it was 6.375, and the debt ratios allowed our borrower to qualify for more. And so we were trying to push him as high as possible because he wanted the opportunity to purchase a property. And so when you look at these first-time buyer programs, it's not always, this is the best program. It depends on your particular situation. Let's take a peek and go through a matrix on the program requirements, and then I want to show you some more stuff. I mean, there's so many layers to buyer programs. There's a lot of ways you can get hung up, and if you're not a savvy loan officer with a team that's really great at figuring things out, they can fall out. And we have our lender that we partner with, Orion. I've known my rep Laura since 1998. I actually started at Marina Mortgage with her, and she is so very good. And they underwrite TPDs. What that means is we can ensure your success and quick closing by doing the whole loan application, submitting it for an underwritten approval. So we're going to get your whole loan underwritten, approved in hand, a full conditional loan approval before you even go out there and shop and start writing offers. And that's going to help you get your, that's really going to help you get your offer accepted too. Okay, I'm trying to pull up this. Oh, I need to escape out of this. Let me escape out of that. So this is our matrix, right? Then, okay, so this is the actual, so this comes from our lender. I'm what's called a third-party originator and or broker. It's Orion, our wholesale lender. And National Home Buyer Fund is another buyer program. For whatever reason, they have priced themselves out right now. So we're not really going to go too deep into that. And this is more on the Cheno program and the pros of the Cheno. The National Home Buyer Fund, I wanted to show you something because some of the slides that we're going to look at. Discount points. Discount points are 1% of the loan amount. 1% of the loan amount. So if you have a $550,000 property, what is that? $5,500 is the cost for that rate. Conversely, 0.25%, 0.25 is $1,375. So we're going to use that information in a little bit. But the National Home Buyer Fund, their cost is like 3 points. So it's really cost prohibitive, and the rate's not any better. So we're not even looking at that program right now. But the key is to have your eyes on everything all the time, right? Okay, let's go. Available products, 30-year fixed. Maximum debt ratio. So a debt ratio is, let me see if this is here. A debt ratio is based on a sales price and based on your income is the debt ratio. And in home loans, 47% of your income can go to your house payment. And in conventional loans, this is a conventional loan here, it can go up to 50. FHA, it can go up to like 56.99. And why that's important is a lot of buyer programs, almost all buyer programs have debt ratio restrictions. But this Cheno program is very, very generous. So your credit score is low, you're gonna be restricted. It's gonna be like a hard stop. Like you have to stay at that, 45% debt ratio. But you can go up to whatever the automated underwriting engine tells you can. We'll go into that when we get to that point. Maximum loan amount, not relative, minimum LTV, blah, blah, blah. Automated underwriting system, AUS, automated underwriting system. There's two of them, Fannie Mae and Freddie Mac. Some programs only allow for desktop underwriter, which is Fannie Mae. And believe it or not, like sometimes when we run a borrower through a system, it will allow us to go over a 50% debt ratio. So there's all these variables, and it's all about risk. And so these underwriting engines take into consideration all of these factors and come back with an approved status, and then we can do the loan. Well, if it says approved ineligible, then we're stuck. And if it doesn't also, if the buyer program doesn't also offer loan prospector, which is Freddie Mac, because sometimes we run things through Freddie Mac and it goes, and through use and vice versa. It can work. It can work both ways. So this Cheno program lets you do desktop underwriter, loan prospector, and manual underwriting. And that's sometimes when you've got a buyer and you're just like, I know this is a loan. This is a loan, and it meets all the criteria for a manual underwrite. We have to submit it to a lender that will do it. Sometimes people's credit, I actually see this a lot more where I see somebody with a credit score and I'm like, they do not deserve this score at all. It's unfair, but the reality is it is what it is. So we get into it. We counsel them about, having the right amount of credit to debt, the right number of accounts, the right mixture. And sometimes even then they had some kind of credit event or something's going on where we just can't get the score higher. And in that case, it won't go through the system. Then we have to do a manual underwrite. So this program is wonderful because it is helping all the scenarios. It's really all encompassing program. You can even do manufactured housing. Like that's like the stepchild of the industry. Nobody wants to do mobile homes, and you can even do single wide and double wide on this program. The forgivable loan, you don't make monthly payments on it. It's like a silent second. So if you sell or refinance under the forgivable period, under 3 years, you will have to pay that money back. The repayable one, 10-year term. And again, when people say, why would you even do a repayable? Sometimes there's a reason why you have to do something because of all of these different layers. Whatever makes the most sense for the borrower. Down payment amount, okay. Eligible borrowers, U.S. citizens, non-occupant co-borrowers. This is a big one. Some programs do not allow for that. Permanent resident and also non-permanent resident. And when we talk about why we would look at another program as opposed like this one's good, but over here on that National Homebuyer Fund, they do DACA. This Cheno program doesn't allow for that. So this is something to keep in mind when you're really struggling to find a way or a fit for a borrower, that when the pricing comes back on this National Homebuyer Fund, we might look at that for a DACA citizen or a DACA borrower. Income limits. So this is a biggie. All down payment assistance programs have some kind of income limit or restriction or guideline. And it's usually based on the area median income. What's really cool about the Cheno product is if you're over the median, an area median income is like, I don't know, the average borrower I'm going to use Newport Beach as an example. They have that set at $86,000. And in Rancho Cucamonga, I think it's $68,000. So there's a little bit of leeway difference there, but not that much. And so for each, I think in San Bernardino, it's like 65,000. So each area has a median income that we use. And some programs are really strict. Like you have to fit that median income, and there's no working outside of the box. But in this program, you can, but it's a little bit extra cost. We'll show you that in a minute. You can go down to a 600 FICO. When I price these loans out and you've got an 800 FICO and a 600 FICO, did you know the rate is the same? That's what's so cool about this program is you don't get penalized because you have a 600 FICO. And sometimes people just, they had a bad credit experience, and they just haven't reestablished their credit, and their score is not so good. And they maybe have old medical collections or something on their credit that is dragging it down. And you are not going to get penalized. The problem is, remember, we have to run it through the automated system. So is the automated system going to approve it? And then is that debt ratio restriction going to affect you on your purchasing power? So there's all these things to consider. Here, there's credit counseling that's required, not credit counseling, home ownership counseling that's required, occupancy, manufactured housing, non-occupant co-borrowers not allowed. Okay, that's interesting. And it does have to be your primary residence. First-time home buyer is defined as, have you owned a home in the last 3 years? Have you declared interest expense on your federal Form 1040s? You see, these programs are pretty document intensive. And so we're going to have all the documents and we're going to see all the things. And so if you have not owned a home in the last 3 years, you are considered a first-time home buyer. And what this is saying is that it's not even required. Wait, that's residual. Right here. It's not even required. You don't have to be a first-time home buyer. And some programs require that you are. So this program is pretty far-reaching. Property type, single-family condo, PUD, modular, manufactured, single and double-wide, and 2 units. Huge, 2 units. A lot of programs don't allow for 2 units. All right, fees to originator, BPC only. That means borrower paid compensation. And what that is, in these loans, we don't get paid from the lender. So borrower paid compensation means it's going to show up on the loan estimate as an origination fee, as is the lender fee, the fees for the second, recording fees for the second, processing fees. So these programs, it's hard to absorb any of the cost into the rate because that's just not allowed. So that's what that means. Let's see what else. What else do we have? Okay, if you're watching this, I lend in California primarily, all through California, but this is actually a nationwide program. So if you're looking to purchase and you're looking for a referral, I can help you with that. If you're in California, I can help place you with a real estate agent. This program is tried and true. It's been around a very, very long time. I just didn't think in the past, whenever I looked at it, I would look at it and I'm like, first of all, we can't do a buyer program. We wouldn't get it accepted. And then we could not get anything paid by the seller. There was no concessions at all, not happening. So if you can't get the offer accepted, you won't even write the offer. So what we would do is we'd say, hey, this is how we can do it. We'll do FHA and we'll pay the closing costs. So the borrower can come in with $19,000. But this program, people have been doing it. It works in areas where the seller can pay closing costs. So if you're in an area and like the last year, like I said, we didn't have any offers get accepted, but there were people that were having success for in areas where the seller would contribute. It's definitely a seller contribution type of program. Okay, so we went over this sheet. We went over, let's do spot approval. So a spot approval, what's really cool is that A lot of buyer programs do not allow for a spot approval. They're like, nope, nope, nope. And what that means is when you buy a condo under FHA financing, the condo has to have FHA approval. What that means is they have to meet all these certain requirements, and they have to pay money, and they have to do, it's just a lot of stuff. And if the condo association is in an area where most people don't even need FHA financing because it's higher end, this happens a lot in Orange County and LA. There's not a lot of condos that are FHA approved. But what you can do is something called an FHA spot approval. It's more work for us, no big deal. If it gives you success in the transaction, helps out the borrower, helps out the agent, helps out the seller. So there's a process that we go through where we collaborate with the Federal Housing Administration, and the property has to meet certain requirements. It has to meet an occupancy standard where a percentage of the owners need to actually be, no, wait, how do I explain that? So there cannot be an excessive amount of tenants. That's what it is. There cannot be an excessive amount of tenants in the project. They have to have no litigation. They have to have a certain amount of reserves. So there, it does have to be a good, solid community condominium association to even be allowed for a spot approval. But there's stuff that we can do. And the fact that this program allows for it is huge, because if you're in LA and Orange County, most of the condos are not FHA approved. They are not. Okay, so we did this matrix. Okay, let me show you. There's so much in a buyer program. There's so many layers. That's what it is, right? It's just a layering situation. So here we have the interest rate. Remember when I showed you that thing about the points? Remember the discount points thing? So when you look over here, these are points. At 6.625, this is actually a credit. At 6.5, this is costing 0.125. So you look at the rate. Okay, I'm going to look for, we call it par pricing. So this is probably going to look at this 6.625. And then I'm going to look, here's the repayable and here's the forgivable. And then when you look at, there's a price adjustment of 1.8 on this, let's say if I did 6.5, it's 1.8 plus 0.125. So I might go over here and be like, okay, it's 6.75 and it's costing 1.3. In points, it's costing 1.3% of a loan amount. So when I told you that the loan is just more expensive in nature, so that's a discount that gets added to the closing cost that the seller pays. Additionally, look at all these additional adjustments and layers. If there's a high balance, if you go over, remember I told you the income limits, if you go over the income limits, you add this 0.25 to this cost here. So then it's 1.8 minus a half plus the 0.25. So I think that's like 1.55 or something. 2 units, there's a little extra cost. So it's not like there's a point or two cost for these things. These are minor adjustments, but you have to have all of this stuff going on as you're evaluating whether or not someone qualifies. You're looking at all of these things. You're looking at these things. In lending, I mentioned to you that Orion is a lending partner of mine. I'm a wholesale loan broker. I'm a third-party originator. Orion is someone that I package and send loans to. This is their quick pricer. So let me just go through it really fast. I'll show you exactly what we do. FHA, purchase. Let's include all the down payment assistance. Run all the DPAs. Loan term, 30 years. Fixed rate, 30 days. Taxes and insurance. First time home buyer, yes. Total monthly income, 13,000. One person in the household. Purchase price. Let's do 555,000. Property value, same. Base loan. When we make this an FHA loan, 96.5 loan to value, which means it's 3.5%. this says repayable second, but you'll see the pricing options. It doesn't matter. It's for both forgivable and repayable. Let's just pick DU, approve eligible, zip code. Let's just do here 91786. Property type, single family. FICO, let's do 716. DTI 56. We've got a high back end debt ratio. Run the quick pricer. It's gonna take just a minute. Just a minute. So we can all just have like this Zen moment right now while it thinks. Wasn't that nice? Okay, let's see if it's ready. You're probably this girl. Oh, look, it's still thinking. Okay, there it is. Now the lock desk is closed. So this is pricing from earlier today. Let me go to the one, because the one that I was highlighting was the forgivable. So this is a 30-year fixed, 3.5% down, forgivable Cheno. And so for this 6.75 rate that this was on the sheet and calculated in the sheet, it's costing 1.5 points. And again, that is paid by the seller. If you were having to do this loan and you were having to pay this $30,000, it really would make 0 cents at all. But since we're getting this from the seller, we could get 5,000 from the seller. We could get 20,000 from the seller. I really think though, if somebody could come up with 5 or 10 grand and we could get, 15 or 20,000 from the seller, you can make this scenario doable. And right now with sellers doing price reductions, if a property has been on the market for 30 days and, you're an agent, I'll just use Temecula or Menifee for an example. You're in Menifee and you see this property and it comes on the market and you're like, yeah, that's property is overpriced. And then they do a price reduction. It sits a little bit longer and it's been 30 days. And you think, hey, I think that property is like fairly priced, but it's been sitting for 30 days. You're going to call the listing agent and find out, hey, I've got a buyer. We can close in 30 days, but they need $20,000. Do you think that is something that your seller would entertain? And the listing agent will tell you, you know what? There's absolutely no way. There's no way that they're going to take that offer. And then you, as an agent, you might go ahead and write the offer and send it over. This is where a really good agent, somebody that knows the market, somebody that has relationships in the area, because we all, I've been doing this since 1998. You know how many agents I know? I know a bazillion agents. And sometimes I can help get the offer accepted just because of relational type of things that they know that I'm going to do what I say I'm going to do. Yeah, I'm going to close a loan in 25 days or whatever. We're going to remove contingencies really soon. So the buyer's agent, your agent's duty is to make nice to the listing agent, find out, what kind of offer we can write. If we don't have a chance and and they've got other offers where they're not asking for $20,000 of closing costs, your agent is probably not going to waste time doing it. But if there's a shot, he or she is definitely going to shoot it. And that's what you need. You need a shooter. You need somebody who's going to shoot their shot, right? You need someone who's going to work hard for you. You need a savage in this market. And there's a lot of opportunities coming up. I cannot say that enough. These buyers, you have been shut out for 2.5 years. It's your turn. It's your time, Mr. and Mrs. Buyer. Okay, so I just kind of wanted to show you, I feel like your head is probably spinning because ours does. When we have to go through and this is just one program, the Cheno program. Imagine we have with this buyer, we have done this with this NADA program. We've done it with the Cal HFA program and then the Cheno program. And then we look at pricing and we send it out. And this is your max qual. And then the next day, it goes up 0.5%. And you're just like, holy cow. But we do it because we can. And it's in the buyer's best interest to always stay on top of the market and give the best information that you can. And it's just like us, we're going to shoot our shot too and make sure that you're in the program that's right for you now and into the future. My name is Teresa Timms. I've been originating home loans since 1998. I serve the entire California market. And if you're looking for somebody to help you get into a house and become a homeowner, please pick up the phone and call or text to 909-920-3500. Even if you think you're not ready, even if you think there's no way. You know, if you don't just start somewhere, you'll never know. You'll never know. And you want to get in position, right? Get yourself in position so that you can take advantage of all the things that homeownership has to offer. Have a beautiful day. Like or comment, subscribe below. I want to know your thoughts, challenges. If you've been in the market, I'd like to hear from you. If you have any questions, even if you think it's like the silliest question on earth, I answer all of the comments personally, and I would love to help you and answer anything that you come up with. Have a beautiful day.